Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Oh, g'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group, back in the studio with my friends and colleagues and common investors.
We're related by common investment, is it?
We look related. Yeah. Related through investing. Victor and Reshmi Kumar, gang, how you going? Good to see you.
Good.
Yeah. Already September?
Yeah, I know. Yeah, it's flying, absolutely flying.
But how did that happen? We just started this special series, Design Your Decade, in December of 2024, and here we are looking down the barrel of Christmas.
I know.
I'm just ready to take a break. I just feel like the holiday season starting now. Like I'm going in.
You guys actually do take a couple of weeks over Christmas,
We do take quite a few weeks over Christmas.
Yeah.
And that's our chance to regroup, recharge, reconnect with the family, reconnect with each other. And
that's where you do your planning as well.
Boxing
we
Day,
went through
yes.
this, your Boxing Day planning.
Yes.
Normally with a massive Carver hangover. Do you get hungover from Carver, Victor?
Only if it's
this
a
is
bad
those
batch.
dialing into his Fijian Indian roots. No, it's only...
only if it's a bad batch.
You've been threatening me for years for a good Carver session and you've never...
I don't think you'll be able to handle it.
No,
That's
I
it.
don't know.
I think what we should do is put the cover bowl here in the middle.
Oh, okay. Stop putting
One day.
ideas in my head.
Yeah, there we go. Yeah. Maybe,
my
maybe
God.
let's do a Carver.
Yeah. A
I know
Carver
there's-
chat.
There's quite a lot of symbolism around Carver, isn't it?
It is,
There's
yeah.
some process and
Yeah.
there's lots of clapping by memory.
That's it.
The last time I got stuck at St. Carver in somewhere in Fiji. But we should certainly do that. But it's not what we're here to talk about is your Carver habits. However, there is different qualities of Carver, correct?
There is.
So what's the Dom Perignon of Carver?
I plant
I'm sure that's all you drink. But,
a plant that's more than 5 years old, or preferably 10 years old.
Okay.
Yeah. So as the plant gets older, the carvanoids in it.
Yeah. Carver what?
Carvanoids.
Carver. It's actually called a carvanoid.
It is called carvanoids.
That's
yeah.
made
Okay.
up. Yeah.
It's it does have a better effect and better taste.
Okay.
Is it sedative?
It does give you muscle relaxing and gives you a good feel.
So is the pill that you get, the sleeping pill made from kava, is it any how does it relate?
That's toned down.
Really?
I think, yeah.
It's not the real stuff. You need your vintage, your aged vintage Carver. Is it like a 100-year-old plant that everyone it's the mystical plant that everyone wants a Carver?
I don't know.
This one,
Because
it's
you
your
gotta
homework.
uproot it, and it's the roots that you actually powder out.
Oh,
and
okay.
have
So you got to grow it. So you only
Yes.
get one crack at it.
Yep.
See, I don't know any of this stuff. It's learn something new.
You
every
should
day.
visit our home.
I know.
There's some
Lots
growing
of
in our
plants there.
backyard.
Yeah. There's planes that fly around looking for those plants.
No, this is not hemp.
They're looking for carvanoids. To all our Fijian friends, maybe we could get some good Fijian investors in here and we could have a good old Carver session. I mean, let's do that for Christmas. But this is Design Your Decade, and no doubt, potentially Carver can help you think a bit more creatively around your portfolio as you shape your decision making around it. And we're well into our rhythm and our motion of our special series of Design Your Decade, which is a 12-month initiative of a Right Property Group and this podcast, Property Investing Insights, which we've been doing now for 7 or 8 years.
No, more than that.
I would imagine.
Yeah. I think we've gone past the 10th year.
I've done 10 years of smart property,
Yep.
and I've probably been doing podcasts with you for that long.
Absolutely. Yeah. I know. It
Horrible.
shows.
It shows. But as we all know, property is a long-term game, and if you set yourself up right, if you get going early enough, you could potentially have 4 or 5 decades in property as a property investor to the point you decide to depart this earth, and maybe property investment can provide a much better life after work for you than other people, and everyone gets to a point in their property investing journey where maybe they pull back on the throttle a little bit and move from an acquisition accumulation phase into more of a neutral position or a neutral posture, and then the focus really becomes around smart defence,
Yep.
protecting what you've got. And last time we all got together, we spoke about one of the Ds, which was debt. We sort of spoke about, how you go about using debt as the fundamental driver of growth in your portfolio. And debt has commonality across all stages of your portfolio. But there's three other Ds, so 4 in total, that we want to work through. One is defence. We're going to chat about that today. Another one is around diversification. And finally around direction. And we'll probably pick up direction as we get towards the back end of the year when we start bookending where we started this particular series, where we're talking about the whys and what fors as you enter Chrissy. So defence is key.
We came up with these, like the 4 Ds, based on our many decades of property investing and how people get derailed and how people get caught up in jargon. And so what we're trying to do over here is to drill it right down to the bare basics and the knowledge base and the mindset you need to have, so that you can actually build a portfolio that actually enhances your lifestyle and leads you to retirement. And I'm going to do a big shout out to our colleague Melissa Matheson, who's gone through this process.
Matheson.
Yes, she's gone through this process.
She's emailed me about 1,000 times.
So she's decided to try retirement.
Like real retirement.
As in real retirement.
Yeah.
Now, I hope she fails miserably and has to come back and start working for us. But she's a testimony to how a structured approach to building a portfolio can actually get you to your goal. You don't have to do crazy stuff. This was methodical. This was thought out. Now she's at the stage where she's choosing to see, okay, how does retirement look for me? And let's take a tilt towards that. Wow. And if it doesn't work out, the door's open.
Are we okay to talk about her very quickly? Is she okay? You can give us much
she is
details
now.
as you want. Yeah. So I want to ask how old she is, but I won't. But she's
this is early retirement for her.
It's early retirement, right? And does she have very ambitious views of what retirement is, or it's a comfortable position?
It is a comfortable but very comfortable position.
Okay.
Yeah. And one of the things with her permission, we'll bring her to the podcast and share the journey, because I think that her journey itself will inspire so many property investors. We all start out looking at, okay, where's this leading? It's very fuzzy in the beginning to see, okay, am I really going to get there? Or am I going to be that very small cohort of people that will actually reach and touch the Holy Grail?
Yeah.
Or am I going to just be someone that gave it a good red hot go but didn't quite get there?
Yeah, I have a quite a lot of dichotomy personally with that, because I operate in and around property. I meet a lot of people, and I think a lot of people, I get access to some of the greatest minds in property. But for me, property investing is such a afterthought, a non-structured afterthought.
Yeah.
It frustrates me at the same time of excites me, because I could probably pick it up and be a lot more structured quicker and advance faster with it. But I've done a very poor job.
No, I think
strategic, but this is most of my personal view. Like, my portfolio, it's a pretty good portfolio, but I think it's small. It could be significantly larger than what it is. Do I need to be any larger? It's not a small portfolio, by the way. But it's just really just happened through consequences. And I really haven't. I probably have been, but I haven't really been structured on it. Then I hear people like Melissa. It sounds as though she's been very structured and methodical through the whole thing, and I go, well, imagine if I actually did this like that.
Yeah.
But the practical realities is, well, you couldn't and I didn't. So
So you have a lot more other things going on in your life. So you've got your businesses to run.
Yeah.
And so where would you be content is not something you have come up with yet.
And that's the point, right?
Yeah.
But it's hard to not compare you with other people's circumstances and situations. And, there's old ages, you can't compare your chapter 4 with someone else's chapter 10. But I imagine she might have different circumstances for what she created. But like, how big would her portfolio be in terms of number of properties? Not that it was irrelevant.
Watch this space when she comes on.
Oh God! See, you see what he's done. See what he's done. He's excited. He's given us. But these are the real stories, right?
See, but the good thing is, I spoke to her this morning and I said, like, when I want to go somewhere, because you get this freedom, you've got all this time, and you want to go somewhere or do something, there's nobody to do it with. And I said, hey, look, if you're going, Elaine, if you're going out somewhere, let me know.
You hear a lot about this with people who sort of enter retirement earlier, and they go that you think it's a great idea, but all your friends are still working, right? But what is better, knowing that I wake up today and I've got to find something to do and I might not be able to find because everyone else is working, or the guilty pleasure of feeling as though, hey, I know I should be working right now, but I'm really doing this and this is what I really want to do. I'm more of the latter than the former.
The thing is, when you know you are in control, none of that matters.
Yeah.
It's just so good.
Yeah.
You've got
and maybe that's retirement. But the only way to do that, the only way to manufacture your circumstances is to acquire property strategically and then defend your position.
Yes.
And defence is key. And we'll kick off here. And no doubt it's fundamental. It's building your financial buffer is critical to defence, isn't it?
Yep, absolutely. You want to take that on?
The buffer.
Yeah, financial buffers.
Yes. Okay. Well, yesterday I was talking to my personal trainer. I said, hey, look, what is the first thing that would put comfort if you're investing? Like, she's an investor. What would be the thing that brings you comfort? You investing? I just have to make sure I have this much money saved up in case there's some emergencies. And so we went through that. And that is a very common thing. Like that is the biggest fear people have, should something go wrong. So there has to be an amount of money that you save aside so that when life circumstances happen, you are actually safe. You're stepping away from that investing, but you're not stepping out of the whole game of investing. So allowing that time, especially for women, a lot of life changes, life circumstances happen. So maternity leaves or a loss of a job or something like that. Then you've got the buffer and you can be comfortable with that. So that is something very important, and one of the biggest things that people, when they scrape up all the money and buy a property with the deposit and the loan and all the rest of it, but there's nothing left. So that when a situation arises, how do you cover yourself?
So how big is too big a buffer? And what would you give us some guidelines, Vic?
Okay, so the guideline really comes...
Your buffer's probably $100 million in the bank, just so you know.
No, it's all in the kava plantation.
It's in the kava plantation. Invest in kava, I'm told.
So it comes back to the mindset and the personality of the investor, right? So for some, they'd be quite comfortable because they know they can get money, right? They can really run it on a smell of an oily rag. Whereas others, they really need at least 6 months, 12 months of repayments in check. When an investor is starting, obviously capital is a premium. Yeah, so it's a finite number.
Yeah,
and if you're putting aside too much for the buffer, then it compromises the type of property you can buy. So it's a juggling act in there. But ideally, you should have at least 3 months of full mortgage repayments set aside.
for your whole portfolio.
Yeah.
Okay.
Which also means like the loan, the type of account you have where you've got access to the redraw facility.
Make sure it's working for you.
Yeah. Whether it is principal and interest, whether it's interest only, all of those things come into play.
Yeah.
And buffer is not just the capital side of it. Buffer is also your ability to earn income, continuous income.
Okay.
So if you've got a hiatus in income coming up, say as an example, you're going down the path of changing jobs. Yeah, you need to buffer up first before you change that employment modality, so that you're not then really struck into a position where you've got no money left and you then are forced to come back to the original play.
So if you've got certainty assurance on predictable cash flow, say if you're self-employed and money coming in every single month reliably, can you operate on a smaller buffer?
You could, because you've got absolute surety in terms of income coming in, and I'd imagine that it'll be the income is better and bigger than the PYG scenario. So yes, you can.
Yeah, and again, it's a mindset thing. What are you comfortable with, and how creative can you be? If you need to find money quickly, you know, but the best place to find dough is to have it sitting there working for you, and that would be an offset. It's the best place to park your money in.
And so in our early days, I took out a unsecured line of credit as my buffer, right? And I've still got it. I was just going on my banking app today and I realized it's still there. It's undrawn. It's sitting there. It gets declared in all of the loan applications. And so it does reduce my borrowing capacity slightly. But I've got enough income buffer to wash that out, right? But it's something that it's there, right? So if you're just starting out, a buffer could be, provided it doesn't impact your borrowing capacity significantly, you could get an unsecured line of credit. Most banks have that, where you are paying a slightly increased interest rate, but you're only paying that
You draw
if
it down.
you're drawing down.
And is always secured against the property,
No,
usually?
no, unsecured. So
Unsecured.
usually most banks will give you, and again, check with your broker, check with your accountant. Most banks will give you between 20 to 30K unsecured.
Okay. What about just having access to credit cards for the same purpose?
Your line of credit may be cheaper.
Yeah.
Yeah.
Yeah, well, if you don't pay
Yes.
off your credit cards, you're at 27%,
Correct.
right? So I'd say your line of credit would be substantially more cheaper. But for short-term emergencies, again, it's not financial advice. Speak to someone that knows what they're talking about. But
Plus, the borrowing capacity for the future property would
Yeah.
be much lesser.
and that's the
compared
issue
to-
you've got, right?
Yeah.
The more
Yeah.
access you have to contingent debt, the less the bank is willing to lend you. So
That's right.
Absolutely.
your best buffer is a cash buffer,
Yeah.
sitting in an offset working for you, getting
Yep.
5 and a bit percent.
Maybe it's
another
something
6.
as simple as, it's just a little bit of money management. You're putting aside 10% of your income as your continuous buffer. Keep adding to it.
Yeah. Yeah, it's structurally, and putting it somewhere where you can't see it's
Yep.
always a good way. There's lots of tips and tools around that. So let's talk about in terms of defence and the power of due diligence. And it's easy in a hot market to sort of get tempted to rush into a purchase. When you sort of move into a more defensive posture, you need to be a lot more conservative potentially in your decision making versus how you might have been when you were
Right
in
at the
acquisitions
beginning.
mode. And you can get conditioned to always wanting to sniff out a deal and getting excited about a deal. You see them every single day, you
Yep.
guys. You've got to be able to temper yourself and go, nah, walk away, walk away. Does that happen, Reshmi? No.
For the listeners that are not on YouTube, Reshmi's pointing slyly at me.
Yeah.
I don't know what she's on about.
You can walk away.
I can now.
Does this still come
I
on and
can.
go, oh, you should see this thing I just seen. It's going to be great.
Yeah, early days. Early days.
Not anymore.
Yeah. No.
What,
Now
what,
it's
what sort
just-
of deal? What sort of deal can't you guys walk away from now? I know you're probably in a defensive setting in your portfolio.
yeah.
You're not actively buying, but what needs to pop up for
Oh,
you to
we're
go?
always buying.
I know.
We're
Always buying,
yeah,
but
if the right property
you know,
pops up, yeah.
the thinking is different. You see a property, it's got all these opportunities, and it's like, yeah, okay. It doesn't phase us like that.
When is the juice worth the squeeze? Because I guess point you just go, it's too small. I
Yeah.
can't be bothered. I don't want to deal with it. Like what moves the needle?
Yeah, no, so I don't want to be egotistical about this and sound egotistical, but as your portfolio grows, the squeeze becomes harder, in the sense that you're no longer, and this is taking a defensive approach, right?
Yeah.
So the mindset always is, okay, I grab a profit, but is a 50K profit worth that in your portfolio?
Yeah.
Is a 150K profit worth in your portfolio? So there are different numbers we're talking about, and it's really important that we don't get caught up in, hey, I'll make a quick 50,000 on this.
Yeah.
Works in the beginning years, but as your portfolio progresses, they can be more of a putting your portfolio at risk than anything else.
So it's not defensive, and there's a lot of consequential other aspects if you keep doing that, and that is you got to remember that the more you're transacting, the more there's consequences with tax and
Yep.
and how you organise that, and how you calibrate that, and the more moving parts you have,
Yeah.
the greater the risk if you're taking a defensive
So you're making
position.
a noise unnecessarily in your portfolio and everything else. I think.
That's a good way of putting
So-
it. Yeah.
yeah.
Yeah, and sometimes you just don't want the noise,
No.
right? You just want to cut the noise out. And
Yeah.
I sit there most mornings and go, how do I decomplicate my life more
Yeah.
than what it
Yeah.
is? I'm sure you guys do the same thing,
Yeah.
just going, what can I cut away? And often you just go, I just don't need another
No.
real estate transaction to potentially make. Even like doing refinancing, pulling out, and again, put in the context, like pull out 100K, I just go, stop.
Yeah. Why?
It's all right. But it's all relative.
At that time, when you've reached that level in your portfolio, I think you're more focused on reducing the debt
Yeah.
and all the rest of it. So, I mean, a lot of in a lot of podcasts, we've talked about building the portfolio, buying the property, but we also have to think about the exit. And so whatever we do in the middle years, what we buy, what are we selecting during that phase, has to be really very well thought through, because we've got to exit out of this buying property, the investing. I'm an investor. You've got to be realizing that income.
Yeah.
You've got to come through that to the other side, and as quickly as you can, so you can enjoy life. You enjoy
I'm just a holder
work.
rather than an
Yeah.
investor. And that's why it's critical to
Yeah.
the key point here is to structure your loans strategically.
Yeah. And so just going back to the due diligence side of it, right? And especially in a fast-moving market where it's hard to latch onto a property. There's a strong buyer's agency activity out there that's also clouding the market quite a bit. This is where due diligence comes in, where you must make sure that you're doing structural inspections. So best in building reports. So don't renege on that. If it's a brand new property, then perhaps you could renege on that. But
I don't know. Some new build properties have worse
Yeah.
building
That's true.
reports.
Yeah.
Yeah.
So there are some non-negotiables in building up your portfolio, and part of the defense is making sure the diligence is there. If you're buying it to say build a granny flat on it, what diligence have you done on this? Have you talked with council? Have you checked the sewer diagram? Have you checked the easements in the backyard or the side yard, to see whether the full strategy can be materialized? Otherwise, you end up with another dud in the portfolio.
Yeah, it's the last thing you want. And the point we sort of spoke very briefly about, we spoke about briefly this podcast, but at length the last time we got together was around debt. So this key thing about structuring loans strategically, you spoke about sort of P&I versus sort of interest only type stuff. It's the fundamental defense mechanism is to have good loan structures.
Yeah.
Which we've covered here.
Yeah. And for if you wanted more in depth on that, just go to the last podcast where we talked about busting finance myths. We've spoken quite at length about it, and there are many different approaches. But the ultimate is that want to make the structure of finance as easy as possible, so that a refinance becomes fairly easy, and also managing the loans from a record keeping tax perspective becomes easy as well.
Yeah, structuring is key, and the way I do it, I maybe over engineer a little bit, but I like for larger, more expensive properties with larger debt, I like to pigeon pair a loan with an offset and just keep it isolated to that asset.
Yes. Because they're not necessarily as liquid as the smaller assets.
No, they're not. And if I've got a bundle of smaller assets, I might operate them out of one bank account to 4 or 5 properties.
Yes.
And that one bank account might offset one of those particular properties, but everything else will be administratively connected with that, which allows you to administer it very well.
Which was a pain at the a little bit before
You
for
guys
us.
do the
We
same
did
way?
we did a bit of cross collateralization.
Yeah, we spoke about that. Sometimes it's good to do cross collateration.
Yeah, it was allowing us access to the money, but now we're in the process of sorting them all out. So it's another
So
process.
to individualize everything, or are you still clustering certain assets?
The clusters within entities,
Yeah.
but we're still within the bank. We've got now trying to talk to them to give us the sub accounts and the limits per property, so we know exactly what's where.
Okay.
Because that's important, right? In case you did want to do some work on a property or sell down a property, we need to know exactly what that property owes you, not just operate out of a master limit.
Yeah. And again, it can get complicated. You've got to organise in a way which makes sense for you. You know, and how you're wired. But it's funny. I still carry around do you carry a wallet? Or is everything?
I still carry a wallet.
I carry a wallet, and I've got literally. I reckon I've got 20 cards in it. There'd be probably
different accounts,
7 or 8 work cards, which would be one like for different businesses. That I would have other cards for my personal use. I don't know. This stuff here is business expenses. This is personal expense. This is I'm buying that for this particular thing. So people go, well, why don't you just carry it on your phone? You go, well, not all the cards work on your phone, and I've got to do it that way because I know if I do it at the point of sale, that means it's so much easier to do the administration and tax connected with it.
Yes,
this is around sort of structuring as well.
Yes.
because it's a nightmare.
It is.
It's an absolute nightmare. But picking through accounts, trying to work out what you spent, what for what is, and I'm sure we've all been there. It's a nightmare. So do it better. Is another area around defence which often overlooked and sometimes undersubscribed is around insurance, which is your sort of classic tangible risk mitigator, and you should have insurance against all your investment properties. But a lot of people, unfortunately, probably underinsured.
They are, especially with the way building costs are moving up at the moment. So, again, we're not qualified to give you insurance advice, and this is just general, based on our
General in nature, blah, blah,
Your
blah, blah, blah.
defending your own ability to get your income, that's also another one. Like, you should be able to protect your own income.
Like income protection insurance, and then you've got life and TPD stuff. You can insure yourself as well as your assets.
Yeah, so that really there's only two aspects you are protecting. One is the cash flow, the other is the capital, right? So the cash flow side of it, it's your ability to earn the income, and the property's ability to earn the income. So in other words, landlord insurance and income protection insurance. And from a capital point of view, your life insurance, trauma insurance, because if you're gone, you want a big capital injection back into the portfolio to really make it a something that you can keep and not do a fire sale. And then the second is, of course, the building insurance. So if the property does burn down, gets severely damaged, it can be replaced.
You always rejoice when your properties get severely damaged and burned
Within
down.
reason. Within reason. Yeah. So long as no one gets hurt.
As long as no one
it's
gets hurt,
adequately insured. Yes. But it is a hassle, right? It is a hassle. However, every misfortune has got a silver lining if you know where to look.
Yeah, and under insurance obviously is the concept of it might be insured, but does the insurance or the payout of that insurance actually compensate you for the actual cost connected with it? And you need to really pick through your insurers quite. And I don't want to talk about life or TPD or income protection. You should speak to a financial advisor in relation to that. But when it comes to specific policies around property investment, you've got to read the fine print because there's certain things that aren't covered. Don't assume it's just covered that way. And good luck also. Like that, just don't think that if you've got a claim, they're going to make it easy to get the dough. Sometimes you need to fight.
Do you want to share the Esplanade? I think we talked about.
Yeah, we talked about that. Yeah. So it's having the insurance is one thing. Knowing how and what your rights are within that insurance is another thing. So be prepared to bring in the experts. If it's a large claim, be prepared to bring in the experts so that they can maximize the claim legally and making sure that you're not leaving money on the table.
Yeah, absolutely, and that's why using an insurance broker can be effective. You go direct, you're just going to get one sort of very linear way to do it. If you've got a broker, brokers that act and operate on your behalf, particularly when it comes to claim, and also your property managers can help with claims as well.
They do. Now again, looking at it from where the market, and this is defense in itself, right? Understanding where the market is. So as we are in a high level of employment, two of the industries that have the most attrition is usually the building industry. So your roofers and tilers go and start driving forklifts. Easier job, 9 to 5 or 9 to 3. And the property managers go out and do easier jobs, right? So clerical jobs, that's abounds everywhere. So the juniors get promoted to seniors, or the seniors that remain now have double the portfolio to look after. And so understanding that at this point in time, don't take the advice just at face value in terms of if the property manager is coming back to you and saying, I don't think this is a claim. Simple things, knowing that, ask, get hold of a broker, get hold of an insurance advisor. They can walk you through it, assuming the claim's big enough, right? And here's a huge challenge out to all of those insurance brokers out there. For the last 15, 20 years, Reshmi and I have been trying to get an umbrella cover. Because we've got a lot of properties, you've got a lot of properties, right? So if you go piecemeal, it does add up quite a bit. So if there's an umbrella policy out there that can be created where it's more of a portfolio insurance rather than an individual property insurance.
Sense.
It
makes
makes
sense.
sense.
Portfolio. I think there's innovation certainly there. And to property managers, I'm a big advocate of property managers that use them all. Properties, obviously, I invest in property management software and stuff like that. Not for this podcast, but as an investor, not all property managers are created equal. And I won't talk about it on this show. I'll probably talk about a smart property investment. But I've had a really bad experience recently, and I'm still going to work out whether or not I'm going to name going to name the property manager. I would have thought they would have Googled me before they actually gave me the experience that I had, but it was in relation to insurance orientated thing and their willingness to support me in that regard. So I still got to work out whether I'm going to name and shame. I feel like doing it. I don't know if it would be fair for me to do that. I'm sure they've got their side of the story.
Right. I'll bring in the soapbox.
Yeah.
And we
Don't
can,
worry, I am not happy with one, and they are about to lose a lot of business. So.
Yeah. And a lot of it can be to the point. It's a tough job, and you've got, people don't wake up and just go, well, when I grow up, I want to be a property manager, right? You end up there because
you fall into that.
You fall into it, right?
Yeah.
Great career, but tough job.
It's a tough gig.
Anyway, outside of that, but this is the point also around defence is building your A team. Your property manager is certainly part of it.
Yes.
They're often the most underrepresented professional when people have conversations around their A team, but longer term in terms of defending your portfolio and asset protection, they're the relationship you're going to have most as a property investor. Like you buy. So when you're buying, you might use a buyer's agent, you might use a conveyancer, you might use a mortgage broker. Once that's bought, your relationships with the property manager. So often
Your
overlooked.
income is attached to that. And compliance. These are the things that people don't really look at or think about. But property managers are very important because they've got to. They keep everything compliant.
Absolutely, and your accountant as well is often overlooked. A team, right? Once you get beyond the sort of sexy stuff of buying and where I'm going to buy and how I'm going to buy and did I get a good price. Once that's done, that's very linear. It's a moment in time that the contract exchanges, then it settles, then all that's behind you. Then it's about management, and no one really talks a lot about management.
No,
but
and you've got in amongst that, you've also got the mortgage broker that really should be coming back every couple of years and looking at how they can pick up efficiencies within the loan that you've got. Simple things as interest rate reviews or product reviews. A good team player will actually automatically do that. Rather than just a set and forget approach.
Do you maintain control of your own awareness of your interest rates, or do you expect your broker to do that? Because there are some very good proactive brokers. A mortgage broker might not know what your rate is, by the way. Once the loan's set, it's very hard for them to get the information unless there's new open banking stuff and all that. But you've got to sign it over. They can sort of work it out.
They can.
But do you drive your mortgage broker to ensure your rates are sharp, or when there's an interest rate cut, do you go through?
So it's not always rate focused. Depends on what we're trying to do, why we're getting the loan. So it could be a very high rate, but if the loan is if we're going to be able to get the loan, which will we will be able to use to carry out what we want to do, then the rate is not as important.
But on the maintenance side, though, for you've got many loans.
It's a combination of the broker and us being diligent as well, because you can't abdicate that responsibility. Ultimately, the well-being of your financial status remains with you.
Also, your broker and your property person, they kind of have to work hand in hand in that sense and talk to each other, because the property and the finance, they have to kind of match up. The strategy.
Everyone's got to line up, and your A team needs to match up as well. We've spoken about this before, and if they don't get on, you've probably got the wrong
That's
team.
right. Don't get caught up in the ego game.
It's as long as the buyer's agents, the top of the pecking order, you don't really care how it all falls out, right?
No, I think in all jokes aside, that does change in terms of who's leading the discussion depending on the phase. It could be the broker, it could be the accountant, or it could be the property strategist that's actually leading that conversation. But they all have equal weighting when it comes to decision making, to put all of the pros and cons in front of the investor, and then the investor makes the decision.
And A10 can be absolutely critical in keeping you accountable for your decision making. Another point here around defense of your portfolio is be wary of big, bold claims. You need someone, if you're that way inclined and you chase the next shiny object, you've got to structurally make sure you've got a couple of trapdoors there to pull you up.
No, there's plenty of those happening at the moment with people vying for business, people spruiking how well they've done, how much growth they've seen. What we want to be really careful is that we came through some really abnormal growth because every single thing that needed to lined up around COVID. And so we had absolutely abnormal growth. And so it sort of created this thought process that, if you invest in property, it'll always go up in value straight away. Not necessarily the case, right? So anyone making big, bold claims that, you buy today and you'll be able to extract your money back out in 3 months, 6 months. Yeah, some of them, some properties, not every single property.
Yeah. And that's connected with our next point, which is exercise caution with social media ads. So a lot of people think a social media ad is factual information and people giving you exactly what's going on. And a lot of those social media ads have big, bold claims connected with them. It's what people stop and look at and inverted commas get inspired about. But, this whole idea of fear of missing out, you've got to be extremely careful, where ads put pressure in that regards. And good marketers know how to market.
The hot buttons.
Yeah. And unfortunately, there's more and more of it prevalent in today's, society, and particularly around property investment. And maybe it's just my algorithms. Like, there must be 100 or 200 different buyers agents whose stuff comes up, and when I sort of reluctantly look at Instagram to see what's going on, I just go, I'm bombarded by it.
Yeah.
There's 10 ads for every piece of content these days. Some new bold claim, it's crazy.
And everyone's got a pretty report, right?
Yeah.
Which really is just a data grab when you drill down. Some of them are good reports, but majority of it is just a data grab. Yeah, so be mindful of what reports you're hanging your hat on. Be mindful of what claims you're hanging your hat on. And ultimately, as you're building up the portfolio, the question you need to ask yourself continually is that if things go wrong, will you lose a lot?
Yeah.
And then I guess the flow-on question is, okay, what can go wrong? Life, the property, finance, employment, all of those things, right? So we need to address all of those things and make sure that we've got the sleep at night factor. We've also got the ability to really take a focused approach of lifestyle in the forefront and investing in the background, so it doesn't become all-consuming. Because once it becomes all-consuming, you really then start cutting corners, especially in today's market.
Yeah, you don't want to be in that position. The best investors I know have a good emotional and financial calibration with their portfolio. So it's not governing them, they're governing it.
Yep.
And there's going to be moments of time in your portfolio journey where it might swing one way or another, and that might be connected with, some bold purchases you're making, or you might be sort of stretching yourself a little bit.
Yeah.
And that's okay, but you can't perpetually stay in that state of being stretched and or stressed, because investing in property is going to become a miserable experience and situation.
Well, if you look at the stretch analogy, right, and if you look at a rubber
you must
band,
have stretched a couple of times.
Yes, of course. Yeah.
Don't stretch no more.
That sounds like a song. So if you look at an analogy of a rubber band, right, if you're continually stretched, you lose the structural integrity, right? So you can stretch at times, yes, but you need to then reset back to normal. And that's really important, so that you don't lose the structural integrity of your portfolio. And you're then still always focused on not the acquisition side of it, but more so the end goal side of it. In other words, you end up like Melissa Matheson and have the ability to actually choose to try retirement.
And sort of using a similar analogy to a rubber band, exercising something can make it stronger and more efficient and more productive. But there can be a point in time where you do over-exercise and you create damage, whether temporary damage or permanent damage.
Yes.
So just really having that point of exercising, if you do more of stretching and you get conditioned to be able to operate well in that environment, that can be positive. But there may be a point where you break something and then you're stuffed.
And then it comes back to your individual financial fingerprint and your individual portfolio. And really also your mindset.
And mindset's key. investing in property, there's a lot of things in your control. You can control your finances. You can build the right team. There's a lot of decision making, where you buy, how you buy, what you buy. There's also a lot of things that you can't control, and you're a victim to the whims of economic situation, whatever it is, how property markets are performing. Are we in recession? Are we out of recession? A global pandemic, international headwinds of shaping and influencing what's happening in the Australian markets, legal and regulatory changes from whether it's the at a federal level with rules governing how finance is issued through APRA, all the way down to what the states are doing. So Reshmi, you got to have a really comfortable operating posture where you know what you can control, and you don't overly think the stuff you can't control. And a lot of people have a lot of fatigue and malaise when it comes to some of the regulatory stuff happening in Victoria at the moment.
That's very true. That's very true. You cannot be in control of every single thing. That's why, coming back to the team, that's absolutely important, that you have people who will help you, keep you in, safe. So
it really is. I think safety is a really good point. Yeah. Like being safe and staying safe is not a bad place to be.
You see, you've put all these years in building a portfolio. So you've got, like, let's say 10, 15 years, and then you don't want something that you're not aware of derail everything, and you basically have to end up start all over again, or lose everything just because you did not comply, or the regulatory the regulatory changes. So you have to still, an investor, you are controlling a lot of finance. You're responsible for a lot of debt and all the rest of it. So you have to still take that responsibility.
You have a fiscal responsibility to yourself to be prudent. That's the reason why it's called the APRA, the Australian Prudential Regulatory. This idea of prudential, of prudence. You need to be right across that. But I guess also there's an inverse of this, is where you have all these things happen in a market that you can't control, depending how you're wired. You can see a lot of opportunity.
Absolutely, yeah. And so if you look at one of the things that people tend to do is totally rely on negative gearing to help hold onto the portfolio, right? Yeah. That's probably the worst defense mistake you can make, because if you're totally reliant on the negative gearing to be around for you to help hold on to your portfolio, a regulatory change from federal level, in other words, a tax regime change, will then create havoc within your portfolio. So the intent there is that we want to be investing without taking the tax advantage into account, but still, of course, claim the tax that's rightly yours. Yeah. But not be totally dependent on it to be holding your portfolio.
The more sophisticated you become as a property investor, and I speak to investors from all walks of life, from people who are starting out to people like yourself who have large portfolios, and I get exposure to all levels of it. As people become more sophisticated in property investing, I very rarely, if ever, have tax discussions with them. I can't think of any time we've really sort of tax is a consequence.
It's a consequence.
Yes.
It's a consequence. So it has very little bearing on strategic decision making. It might be a small tactical application here and there, but it has very little bearing on strategic decision making.
Yeah, absolutely.
Yeah,
so these are factors when new people are really getting into investing. They want to know about every single thing, and those are the factors that they use for deciding and whatever is going on. And like the regulatory changes, as we were talking about as well, like the land tax. Remember how during elections they throw in all these things, right? So they are things that can be thrown for election purposes. But you've got to stick to what you are trying to achieve. These are the things, the variables that will come and go, and just make sure that what you are trying to achieve, you can get there without all of these impacting you. So,
it's like you've got to have a very healthy awareness and posturing against regulatory changes. Like it's going to change. Yeah, they come out going, "Oh, we're going to tax super funds at $3 million," and what tax is going to be existing in 20 years' time? You know, when you're sort of back end investing now, you're going to go, "Well, it's got to cop it." You know, you've got to cop it, and that's just the way it is. So maneuver around it. Now, I want to this last point around defence is a proactive portfolio review, and it's absolutely critical. You can do it yourself or get support with it. But before we chat about that, so I want to pick up a little birdie told me, Victor, that you guys are doing a lot more commercial stuff.
We do.
You're going to talk to them about this, or you don't want to say too much?
Not too much.
You're keeping it sort of a bit hush-hush?
The reason being that at this stage, we want to really help our clients that have got a big residential portfolio now transition into commercial, because it's a natural thing, and we've been doing it ad hoc, but now this is more of a strategic approach to help our existing clients. Eventually, we'll open up our books to the general public. It's more quality rather than quantity.
I imagine you've got people like myself with a significant portfolio who have already making that transition to commercial, and I'm a huge proponent and advocate for it. And I think what's happening now is I think that it's been brought forward when people start investing. But I think about now versus 5 years ago, it's been brought forward when people start thinking about commercial, where in the old days, they build up massive resi portfolios and then get frustrated with it, and for whatever reason then start. I think people are now thinking about maybe 4 or 5 properties in.
So one of the podcasts in the new year that we'll be looking at doing is mapping out the whole process of when does the commercial fit in, when does the developments fit in, when does the specialized properties fit in, and what are the foundational properties. So it's not a, hey, I've got a big deposit, I want to go into commercial. It might not make sense, right? Or hey, I've got a decent appetite, I don't like commercial, or so let's shy away from that. This is looking at it from a holistic point of view, and not just being, sitting in the camp of commercial, sitting in the camp of residential. This is across the board, so that when a journey is started, we can map out the various pathways, so that if the variables, as you mentioned, as they come in, we can go down shortcuts, we can go down safer routes, and we can go down some profit taking within the portfolio. And that's a really important thing to say in the sense that property investing is never linear. And it's not, if you consistently and continually buy the same property, the same type of property in your portfolio, you're not really scaling it. So this is an opportunity to really scale it and scale it in a safe manner, so that you are actually getting some generational wealth, and you are then really within the decade looking at getting some important milestones dialed in within that journey. And at the end of 10 years, you lift your head up and look, and you'll see how well you've transpired in terms of where you started from to where you're ending, both from a cash flow and capital point of view, and therefore that directly translates then to choices in lifestyle.
And that's the epicenter of a defensive position. And that's really good. So core to that is the value of a proactive portfolio review. You can make those decisions when you pivot, maneuver. And I know we should do this all the time, and we want to start doing more of it as portfolio reviews. And this is something I know you work with your client base, because that's what you've done with me for the decade or plus I've been investing in property. But if you don't have that network and you don't have a strategist, how do you dial into that? How can you actually get someone to look at your portfolio without really bias or agenda or fear or favour, and give you good, frank, fundamental feedback on it? Do you do that for people that don't?
We do. And this is where, regardless of whether you used our services or not, for our clients, this service is free during the acquisition phase. For people that have not been in our ecosystem and they want to tap into our knowledge of almost 30 years of property investing, looking at pretty much every strategy.
That's a very long time.
Looking at the very different strategies, how to take the shortcuts, how to adjust the journey. There is a paid service where I do sit down with them and do a portfolio review of.
Do you actually enjoy that though? Like, you probably have some difficult conversations with people that might not
I love it.
So you got to pay for it, right? And imagine it's probably based on a tiered structure.
It
because
is
of the
very
habit.
much tiered, yeah.
But do you say stuff to people and they go, oh, I don't want to hear that, or don't tell? Like you need to go into this real open, honest.
Yeah, absolutely. It's getting an absolute health check and a direction in your portfolio.
We're seeing more and more of this happening because there's so many buyers agents out there who have bought properties for people. I'm sorry to jump in there, but it's just then when we do the reviews, we see what could have happened.
Do people, are they disappointed with, like, do they feel as though, well, do they take accountability for maybe some bad decision making, or is it normally there's someone else's fault?
Bit of both, but it's really they don't know what they don't know.
Yes,
And this is like you only know this through hindsight. Yeah, we can have read all the textbooks, you can have done all of the courses, unless you've actually lived through it. Yeah, you can't really know the total nuances of property investing. Yeah, so your investor self starting today and the investor 10 years down the track are two very different people.
And you've got to be kind to yourself also. You're going to make mistakes. You're not going to do it right. But if you can put some guardrails in place so your mistakes aren't too dire or drastic, and this comes back to having the right people.
Yeah, and when I'm doing these portfolio reviews, often it's not about buying more properties. It's usually about, okay, how about we reset this? How about we change these loans? How about we debt recycle? Or maybe we can look at the zoning on a particular property and say, let's change this. Yeah. So working within what you've got to, it's like we bought a car, right? It's nice and shiny, but unless you service it along the way, it won't remain fine tuned.
There you go.
Yeah.
Lots to cover. Lots covered.
Lots covered.
What's
I
next?
just wanted to add a little bit more to that because the review, which is done, what happens is what I notice is people buy and they're stuck in that buying phase. There's no, getting out of it. So we try and focus that when we do the reviews, we try and focus as to how to get out of it.
That's the important bit.
Yeah.
And guess what? The only way out of it is to pay some debt down and be unencumbered, right? So at a point in time, you're going to have to do that.
Yep.
Stop buying, put it into the loans or sell something. So there's lots to it. But so that's the second D, defence. So we're going to pick up diversification.
Yeah, diversification is next.
Okay.
Yeah.
Which is when you talked about commercial, I thought, well, that fits in with diversification.
It certainly does. But diversification, it comes in many, many different guises. So good to see you, gang.
Yeah.
It sounds like lots happening over at RPG. I never call it RPG. I'm old school. I call it Right Property Group. But RPG. What's the best way to track the team down?
So just go onto our website. There's a contact me button there, and there's a few forms to fill out. There are a few hurdles you need to jump through before you
Deliberate hurdles,
because I want
people put the work in.
Yeah, they need to be prepared. Right? So we want to get them to have their second thoughts first when they're talking to us. And importantly, if you've got questions and if you wanted to have a portfolio review, just go on to questions@rightpropertygroup.com.au and put portfolio review in the subject header, and one of the team will reach out and organize a time.
Sounds worthwhile. Well, thanks for coming in. It's good to see you both, and a couple more before Chrissy gets stuck into it, and I look forward to it. That's Property Investing Insights at Right Property Group. Victor and Reshmi Kumar, go and track the gang down. No doubt they'll be happy to have a chat with you. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.